Hi, my name is Jim Lowe. I'm one of the senior instructors here at IFREC, and I'm going to talk to you in this video a little bit about something that most people find horrible, absolutely mind-boggling, and desperately scary. We're going to talk a little bit about calculating depreciation or cost recovery in income tax. I do want to make it very clear at the outset that all of this is designed to help you get an idea of the concept for this information. Under no circumstances should this be considered a means for you to go out and do your own taxes, or even worse, them taxes for someone else. Please be sure you consult a CPA or a tax accountant before ever attempting this outside of a confined context. All right, so we're going to be looking a little bit at the tax deductions. One of them is depreciation. In a previous video, you heard about the calculation of net operating income down to after-tax cash flow. The depreciation is one part of this calculation. We'll go through that specific element of the formula, calculating the depreciation, go through an example, and then you can go back and refresh your memory and see how it integrates with the other parts of the tax calculations. To start off, this is a formula that you're looking at, which should be very familiar to you at this point. It's the reconstructed operating statement going all the way from potential gross income down to the after-tax cash flow. We'll be taking a particular look at how the tax liability is calculated, and as was mentioned in a previous video, you start with the net operating income, add reserves, pull out the amortized loan costs, pull out interest, and then you get to depreciation, which is the subject at last of our discussion here. The depreciation formula is really what you've got to get comfortable with and think through the process of how the amounts are calculated. It all starts with the purchase price of the property. To that purchase price, you would add the acquisition costs. We'll go through those in a minute, but essentially those are things you spend in order to acquire the property. That gives you the original basis of the property. Only the building or improvements part of the property is allowed for depreciation, or as you saw in an earlier slide, with the IFREC cost recovery. You'll usually be given a percentage of the building or the site as the total property value. Use the buildings portion of the property value. That would then get you what we call the depreciable basis. That number is then divided by either 27.5 years or 39 years, depending upon the use of the structure. This goes into determining whether the property is a residential investment property or non-residential. In its simplest form, if people are living there, you get the 27.5, an apartment complex, or even a single-family home used for rental. If people don't live there, office building or warehouse, you're assigned a 39-year depreciation period. By doing that division, it gets you to the annual amount of what they call depreciation or cost recovery. That is the amount that's then subtracted from the income to calculate your tax liability. So we'll go through this calculation with an example that you'll see coming up on your slide here. I'll read through this with you just to keep us on pace. An office property is purchased for $3.1 million, and the buyer incurred costs of $1,800 for a survey, $4,200 for an appraisal, $10,400 in documentary stamps and intangibles tax, $8,500 in legal and accounting fees, and $102,000 in broker commissions. Personally, my favorite part. If the site is valued at 20%, the question you'll be asked, what's the amount of annual depreciation? Taking a look at the slide, you now see we put up the formula from the purchase price all the way down to the depreciation deduction. It's literally now a matter of taking the information from the math calculation problem given to you and placing it into the appropriate slot of the formula. First of all, there's the purchase price of $3.1 million. Now it becomes a little more complicated because you have to add all of those acquisition costs. Those are the expenses the buyer laid out in order to acquire the property in addition to the purchase price. In this example, they add up to $126,900. That brings us to an original basis of $3,226,900. The information given in the problem indicated that 20% of the property value was the site, so that means clearly 80% is going to be the building. That's the point now we apply that percentage to the $3,226,900 to get a depreciable basis of $2,581,520. Because the property is a non-residential use, it would have the 39-year depreciation schedule applied to it, leading to $66,192.82 of annual depreciation that's applied to that particular year. As you heard in previous videos, this is what we call the broker's method. We only look at the first year of the calculation rather than the subsequent years. If you really want to look carefully at the subsequent years, please go back to college and get your CPA. Otherwise, go ahead and use that as the answer to your problem. Thanks so much for viewing. Hope to see you again.